Alright, so my name is Bryan Verrgara. I was chosen as part of Team Hydra to focus on the significance portion of our study. What we are chosen to study is the yield curve and its predictive power of signaling when a recession will come. The significance of the study to show that when the yield curve inverts, it's actually a good indicator to know that an economic recession is on its way. Knowing in advance that an economic recession is coming, people can have a general understanding of what to expect when the yield curve inverts. Not only that, they should be able to understand how far into the future a recession is going to occur and what they should do in order to prepare their finances in order to minimize the amount of damage they will suffer under the recession. The notion of the yield curve holding predictive power in determining when the next recession will occur has become quite popularized, especially because of the last recession that occurred between 2007 and 2009. There was a yield curve that predicted that recession prior to that recession taking place. And because of this, many people now think when they hear the yield curve inverts, oh no, the economy is going to go down, the recession is going to happen immediately, and stocks are just going to go down. So that is why on August 14th, when the yield curve between 10-year bond and 2-year bond inverted, the S&P 500 and also the Dow stocks took a 3% drop in value because people were just scared of the fact that the yield curve inverted. However, that is untrue because whenever the yield curve inverts, GDP actually continues to grow for another several quarters and doesn't even peak until another several quarters after. So this actually presented a buying opportunity for people who are interested in buying stocks. When the yield curve inverted, there was a sudden drop in stock prices because people got scared. Even though GDP is supposed to continue to grow, people still got scared. So when you buy these stocks, you can expect them to keep continuing to grow and then earn a profit on them within the next several quarters before the recession actually takes place. So as mentioned before, just because the yield curve inverted doesn't mean GDP is going to drop instantly. It will continue to grow for some time before it peaks and then take a decline from there. Given ample time knowing that a recession will come after the yield curve inverts, one can also know what industries will be affected the most, as in which ones will take the biggest losses and which ones will be the most static, but also which companies will actually see a surprising growth in profits and sales and stock price during that recession. One of the industries that will be affected the most will be the finance industry. Some of the businesses that are most well-known part of the finance industry include banks. Banks that trade in investment banks, regular banks, they're all really tied into those yield curve percentages and those interest rates and stock prices. So when the recession hits, they get affected the most. For example, one of the banks that took a big loss during the economic recession of 2007 to 2009 was the Bank of America. At the end of 2007, right before the recession started, their end-of-year stock price was priced at $41.26. And at the end of 2008, exactly 1 year after, the price dropped from $41.26 1 year after to the price of $14.08. This is a huge 65.87% drop from the end-of-year stock price from 2007 to 2008. This is supposed to represent exactly how much banks are affected by the recessions and the yield curve inversions. Another sector of the economy to know is that higher-end brands, companies such as Macy's, actually get affected negatively by the recession, while other companies such as Walmart and Ross actually see increased profits and increased stock value during the recession. For example, Macy's, which is known to be a store that has high quality good clothing and shoes and whatnot, took a massive hit in sales and stock prices when the recession hit. In 2007, the average stock price for Macy's was about $37.22, while in 2008, the recession took its toll on the economy, and Macy's stock price also fell drastically to about $19.03, an astonishing 48.85% drop from the year prior. It continued to drop the average stock price until 2009, and it continued to drop in 2009 with an average stock price of $13.44. What this showed is that Macy's higher-end product companies get affected a lot by the recession. Although, inversely, lower-end brands known as Ross and these discount companies that are known for having cheaper goods actually seen an increase in profits. For example, Ross saw an increase in profit and stock price following the start of the recession. In 2007, the average stock of Ross price was priced at $7.51. The following year, in 2008, when the recession started to take its full swing, Ross's profits and stock's price continued to grow despite the recession, while other companies such as Macy's and JCPenney saw their prices and stock value drop. In 2008, Ross's average stock price was $8.09, and it continued to grow in 2009 even past the recession with the yearly average stock price being priced at $9.99. This data shows that when the recession hits, lower end products tend to go up in value, up in stock price. So that'll be a better investment to invest in rather than higher end products such as Prada, Gucci, JCPenney. These companies are known to take bigger hits during a recession. Knowing all this information, you can see how extremely useful it is to know when the recession is going to hit, so you could adjust your finances accordingly by taking them out of banks, investment banks, and put them into companies that do perform better during the recession, such as Walmart or Ross. Now, following this, I'm going to have Cristian Ramirez, my fellow group member, talk about the theory behind the yield curve inversion, how it has predictive powers that predicts a recession at some point in the future.
My name is Cristian Ramirez, and I was a lead theorist for this project. In order to look at how the inverted yield can actually affect the future state of the economy, I had to get into two separate questions. The first one is, how does risk work, and how does it build into the price of a bond? So just by looking at the risk and reward trade-off graph, you can see here that as your susceptibility to risk increases, your return is also going to increase, and vice versa. So when you're willing to take less risk, your return is actually going to decrease. So this also holds to be true for the bond market, where typically the long bond is going to yield a higher return than the short bond. And it's partly because you're going to be foregoing some liquidity, so you're increasing your risk, and because of that, you're going to be paid out a higher amount. Now when the yield curve inverts, what we see is that the short bond is actually going to start paying a higher yield. In order to understand that part, however, we're going to have to refer to this formula. So this formula describes the present value of a bond and what it trades for in the open and competitive market. It shows that the present value is actually a function of the coupon rate, which is how much it's actually going to be paid out once the bond actually matures over the interest or the yield. And it shows that once the price goes up, since the interest rate is at the bottom, it's going to actually have the opposite effect on interest. So interest is going to go down. And if price goes down, interest will climb up. So understanding this, we can actually put the long-term bond and the short-term bond equal to each other, solving for I. Doing so will show us what happens in normal conditions, where typically we have the long-term interest or the long-term yield being higher than the short-term yield on the bonds themselves. Now once the yield actually inverts, what happens is the greater than symbol will all of a sudden flip. So we're going to see that the short-term bond is actually going to yield a higher return than the long-term. And this is predominantly just the effect of the price that the bond is being traded for, since the coupon remains ultimately fixed. So one thing to keep in mind is that this greater than symbol will only flip if the preference for long-term bonds over short-term bonds changes. So in other words, if we have an indifference curve, what we're looking at is not a shift in the curve itself. We're looking at movements along the curve, indicating that now there's a preference for long-term bonds over short-term bonds. Because shifts in the indifference curve itself aren't going to change preference for long-term bonds or short-term bonds, and it's also not going to change the risk. Because as we looked at earlier, the yield says a lot about risk, since the price that the bond is trading for has in and of itself built-in risk. So in essence, a yield curve inversion can tell us something about what investors might be thinking may be occurring in the near future. So as things become more uncertain in the near future, it becomes more risk than they're willing to accept, which is going to drive down the price of the short-term bond and increase its yield. Now, before I hand this off to my partner who's going to be doing the econometrics, I want to make sure that we talk about what exactly are recessions. Usually we look at the National Bureau of Economic Research. They usually tell us when we are actually in a recession. Sometimes it takes them a year before they can actually let us know that we've been in a recession, but they're typically the signal that we look at. Most people like to believe that negative growths for 2 quarters are what define a recession. Unfortunately, there's several other factors, and even they state this in their website. They not only look at GDP, but they're also looking at employment rates, and they're looking at a number of other things dealing with business and consumer expenditure. So in our analysis, we're also going to be looking at several different factors, not just GDP growth.
So my name is Gutierrez, and I am the lead econometrician for this applied economic research paper. My job as the lead econometrician was to think of a possible model we could use to answer the question at hand. Before thinking of such a model, it's important to state the fact that there is no solid model that explains why yield curve inversions may or may not predict recessions. So in forming such a model, it was important to to consider what data to use. And it was obvious that we were going to use the spread values. What was not so obvious was the time frame of those spread values. Being the most popular, one of the most popular spreads out there, the 10 minus 2 year spread was an obvious choice, but we had to consider the 5 year minus 3 month spread. In building our model and trying to gauge economic performance, we thought about using the S&P 500 as our gauge for the economy, but eventually we ended up going with GDP, which is a classically stronger indicator and perhaps better for our model. So for GDP, we chose to use the GDP percent change, and setting up GDP percent change as our dependent variable and our yield spread as our independent variable. It was necessary to factor in for other independent variables that may affect GDP, not being the yield spread. So we have to be careful in not choosing variables that had nothing to do with GDP. We ended up using unemployment rate, which is a function of recessions, and also the federal funds rate, which affects GDP directly. Before building our model, it's important to know what results were most likely to be expected. So the assumption is that for every yield curve inversion lasting consecutive months, where the yield spread values fall below zero and become negative, a significant economic slowdown should follow a recession. In essence, a relationship between the yield spread values and GDP should be positively correlated, meaning that whenever the yield curve inverts and goes negative, GDP percent change should also go negative for a certain stretch of time into the future. Having established an understanding of our model and given the limited data set frequency options for GDP, our best course of action was using quarterly data and gathering our data from Fred and deciding to first use a 10 minus 2 year spread from 1976 to 2019. We applied our model and made our regression. Given that we're trying to predict how the yield spread affects the future performance of the economy, a real-time to real-time regression, although useful, does not yield the possible results that we need. So in order to account for this problem of trying to predict how the yield spread affects the future economic growth or recessions, in essence, we had to push our yield spread, our 10 minus 2 year spread values into the future. We accounted for 8 quarters into the future, so in total we made about 9 regressions. The first regression was a real-time to real-time regression of how the 10 minus 2 year spread affects GDP percent change, but also running the rest of the 8 regressions, where the last regression would be 8 quarters into the future, or rather 2 years into the future. So conducting this regression where GDP percent change is a function of our beta naught plus our yield spread plus our federal funds rate plus unemployment, the result for this regression, as well as the rest of the regressions for the like values, was that in looking at the beta coefficients, we noticed that the beta coefficient was maximized at lag 2, or rather 2 quarters into the future, which in a way is at odds with the popular notion that the yield curve inversions predict recessions up to a year. So that does not match up with our results. Our maximized beta coefficient was 1.62, and given the p-value was so small, there was no need to run our hypothesis test. So plotting our beta coefficients versus the lag values into the future, we we noticed that our three highest beta coefficients for the 10 minus 2 year spread happen to be at quarter 2, quarter 3, and quarter 4. So explaining figure 2, or two-dimensional representation of a four-dimensional linear regression. And in this plot, we plot GDP percent change versus the yield spread lag values 2 quarters ahead. The first thing we see is that it's positively correlated, which is something that we expected. And another thing that we notice is that the federal funds rate plays a big role. So the data points seem to be correlated whenever the values for both dependent and independent variables are less than 0. It could also be seen that from the plot, the greatest negative percent changes in GDP also happen to be during the time where the federal funds rate is around 15%. Another thing that you can see from the plot from figure 2 is that the higher federal funds rate is, the steeper the slope is, and the lower the federal funds rate is, the flatter the slope is. Moving on to the 5-year minus 3-month spread and running the same regressions from lag 1 to lag 8, and looking at figure 3, we see that the beta coefficient is maximized at lag 5, which is a year and 3 months into the future. It is a nice plot given that it only has one peak and it's not sporadic. Explaining our results for both regressions, one for the 10 minus 2 year spread and the other for the 5 minus 3 month spread, our summaries go as follows. For the 10 minus 2 year spread, our beta coefficient was maximized at quarter 2, which was 1.62, and our beta coefficient for the 5-year minus 3 month spread was maximized at lag 5, which was 0.88, which was smaller than our previous beta coefficient. Given that the p-values are not significant, there was really no need to run any kind of hypothesis test again. So explaining the plot in figure 4, which is similar to the plot in figure 2, except that it's now using the 5-year minus 3-month treasury spread, we see a positive correlation again, except that the data points are a lot tighter. And one of the things that we could see is that based on the federal funds rate, the data points that have a higher interest rate tend to be up and to the right, higher up and to the right, where the data points with lower interest rate happen to be around lower to the left. The unemployment also has to do, also plays a factor in this plot, where we see a higher unemployment rate as the spread increases. Finally, looking at figure 5 and figure 6, I went ahead and overlaid the lag components of the 10 minus 2 year spread and the 5-year minus 3 month spread over GDP percent change. And from looking at the plots of figure 5 and figure 6, it is noticeable that the time plot of figure 5 is a better overall fit than the 10-year minus 2 year spread.